I remember a client once who sold their business for a multiple that most people only dream of. Watch on for an analysis of how they were able to achieve such a multiple, and hopefully a few tips and tricks that you can take and apply to your own situation. Hey everyone, I'm Andrew. I'm a CFA charter holder and a CFP professional who spent the last several years helping ultra high net worth and high net worth investors with their complex financial lives. And what I do is I take the learnings from those thousands of iterations and I give them to you so that you can apply them to your own situation. This client was able to sell to a public company for a 15 times multiple in their particular industry. And I'm not going to mention the industry just for anonymization, but in their particular industry, a typical multiple was 8 to 10, and they were able to sell for 15x. And so the question is why? First of all, we have to take a step back and understand how are companies valued. And it differs by industry, but many times at the lower level, people will purchase a company for a multiple of revenue as a rule of thumb. And so some industries that have variable and short-term cash flows will be maybe 1 to 2 times revenues, maybe 1.5. And other industries that have more sticky revenues tend to be purchased at a higher multiple of revenue, maybe 2, 3 times. However, once you achieve some scale in the business, private companies are typically valued based on a cash flow multiple. And the most popular measure is what's called EBITDA, EBITDA, earnings before interest, taxes, depreciation, amortization. What that does is it gives us an understanding of the earnings power of a business. What dictates a multiple is risk. The higher a risk to future cash flows, the lower a multiple I'm going to give a business. So what this client did is they correctly assessed what are the risks to the business for the acquiring company, and I'm going to mitigate those ahead of time. So there were a couple things that he did. The first thing that he did was he made himself useless. One of the biggest risk factors to cash flow for a private business is key person risk. Many times the owner was also the best salesman in the company and the best revenue generator in the company. And so therefore, if they were to leave, the revenue is less sticky. What this person did is 3 years before sale, they went and invested in a highly qualified salesperson and started to hand off strategic relationships to that person. By doing this, they eliminated one of the core issues that the acquiring company would have, which is if we buy it from you, how do we know the revenue is going to stick around? In addition, they offered themselves as a contractor for 12 months to the acquiring company as a good faith effort to be able to transition relationships also. As a side note, many times in private equity deals, they will bring you on as an employee so much as you can. I recommend against that because most of the time founders are terrible employees. They are. They're great entrepreneurs. They are terrible employees. And in addition, you end up locking yourself into something and reducing optionality on the back end. If you have money held in escrow for 12, 18, 24 months, stick around for some period of time there just so that you can see things through. But so much as you can, don't tie yourself to the new entity. The next thing that they did a couple of years before the sale is they started to get out unnecessary personal expenses from their business. And you business owners know what I mean. There are some things that there's not a ton of tax risk by categorizing it as a business expense, but there are definitely benefits to you personally. However, what was good for you as a business owner for the last 10 years is not good for you during an acquisition because it's reducing your earnings. And again, if the enterprise value of a business is dictated by the multiple of cash flows, reducing unnecessary personal expenses in the business increases your EBITDA. In addition, they accepted some of the proceeds in the acquiring company stock. Now, I say this with a big asterisk. There are new risks that emerge whenever you accept some of a sale in stock, because now you have a concentrated position. In their case, it was a public company, but public companies don't want you to sell their stock, right? So there's typically a lockup period, and you have to invest around it for a period of time. I have other videos about liquidating concentrated stock positions, but many times, if they have to put out less cash and just give you stock instead, they are much more willing to issue stock to you rather than find money in their treasury to give you. So my client was willing to take 75% cash and 25% in the acquiring company stock. Now, a note for anybody who's considering a private equity deal: many times your company that's being acquired is a part of a vintage that has multiple companies in your own industry. And so one of the selling points they will give you is, hey, we want you to be bought into this, and we're planning to flip your company and the other companies within 5 years. So buy in as a partner, a limited partner, with 10% of your proceeds. That's very normal. There are different sets of risks to that I'll probably go over in a different video. But being willing to play their game and give them a little flexibility can usually increase the multiple they're willing to pay you, because it gives you some other risks that they're able to offload. In addition, on the expense side of your income statement, any unnecessary overhead, and I'm not talking personal expenses here, I'm talking about unnecessary staff, unnecessary technology, unnecessary real estate, those types of things that you built fluff in your business because you were just willing to eat it. I'm telling you, once your business is acquired, whether you like it or not, they are going to get rid of the fluff in your business, because they are in the business of expanding net income margin and expanding the multiple and selling off to another entity, or if it's like a family office, holding for a very long time. There were some specific costs that my client was able to both automate and offload that increase the net income margin of the business. And again, you don't want to just do this in the year of sale. You need to have a track record for a couple of years here. A few items that they did not include, but I want to make sure I mention: if you're not selling all of your business and it's a strategic partnership, consider a put option to be able to sell the remaining shares at a strategic multiple that you agree on ahead of time, or even a call option to be able to buy shares back if the strategic partnership doesn't go well. And the last thing I will mention to you is, remember, the stickier the revenue, the better the multiple, all else equal. And so if you can tie up contracts for 18, 24, 36 months that are going to all but guarantee your acquiring company revenue, that is going to dictate a higher enterprise value for the entity as a whole. So the takeaway here is, private companies are valued based on their cash flows. So anything that you can do to either expand margins, and you can expand margins through a couple different ways. You can reduce expenses or you can increase revenue. Either works. And in addition to that, reduce risks to the acquiring company so much as you're able. That's how this company was able to get a 15 times multiple, and hopefully it's going to help you be able to maximize your exit value as well. Until next time, thanks everyone.